Hello and welcome to Team 2's case study presentation. Our team is made up of Justin Rush, Greg Matsura, and Matthew Hill. The focus of our case study is the cost of capital at Ameritrade. Ameritrade is a very unique corporation. It was formed in 1971 and was among the first to market in the discount brokerage sector. In the decades since their inception, Ameritrade's continued high-tech service offerings have helped change this sector. Their offerings over the past decades include being the first to provide online internet trading as well as trading over mobile devices. Ameritrade raised over $22 million when they eventually went public and have since used this money to continue their research and investments in technology. Ameritrade was also able to use a portion of these funds to substantially increase their advertising in order to build its brand and improve their market share. The two main sources of revenue at Ameritrade come from transactions and interest. The transaction part of the revenue is mostly commissions and fees, as well as payment for order flow, which is cash payments received by Ameritrade for routing orders to execution agents. The interest revenues are generated by charging customers on the debt they maintain in their brokerage accounts. Ameritrade also collects interest on the investment of the customer's cash in compliance with federal regulations. However, most of Ameritrade's interest revenues are offset by interest payments to customers based on credit balances maintained in their accounts. So with this in mind, a majority, if not all, of Ameritrade's revenue comes from the transactional revenue category. In 1997, Joe Ricketts, Ameritrade's chairman and CEO, was looking to improve the company's position in their sector. The key to this positioning was a large increase in the company's customer base and the subsequent revenues generated. The drawback to this was that the investments needed would require a large amount of the company's reserve capital. The exact numbers are $100 million for the technology enhancements and $155 million for the advertising increase. This covers the fiscal years of 1998 and 1999. Because of this, Ameritrade must take a very close look at all of the returns and risks related to these investments. As mentioned, part of Ameritrade's plan to grow their revenues includes not only big investments in technology, but also a big increase in their advertising budget. The purpose of the technology investment is to ensure that Ameritrade possesses the most reliable services possible. Reliability is typically measured by the number of outages, and ideally the new technology would result in 100% reliability for Ameritrade's customers. The advanced technologies would also increase the speed of each trade, another important attribute to the target demographic of their company. The increase in Ameritrade's advertising budget would hopefully increase customer awareness and increase the total number of customers using their services. There are many factors that Ameritrade must consider when evaluating this proposal. The first factor Ameritrade must consider is the cost of capital. The cost of capital is the cost of the funds used to finance the project either through equity or debt. The return of the project should exceed the firm's cost of capital if Ameritrade is going to move forward. Second is the net present value, or NPV, of the proposal. This will take in all the projected cash inflows and outflows and compute the overall value of this project. The higher the NPV, the better the investment. Other factors include the internal rate of return, or the IRR, as well as the debt-to-equity ratio. The capital asset pricing model is a way to find the required return for an investment based on the risk factors involved. A higher risk investment should result in a higher required return to compensate for this level of risk. This slide shows the capital asset pricing model formula where R sub A represents the required risk. The risk-free rate is represented by R sub F and is the theoretical rate of return of an investment that does not have any risk. Usually the rate of a U.S. Treasury bond is used for this number. The beta of a company is represented by B, and this is the volatility of the company itself. A beta of 1 would be a company that mirrors the volatility of the market, while a beta of 2 would be a company that is twice as volatile. The last term is the expected market return minus the risk-free rate and is otherwise known as the risk premium. Ameritrade can use the capital asset pricing model to calculate the expected return, and then this can be used as the cost of capital for their investment. The rate calculated can also be used as a discount rate for their future projects and investments. Using these numbers will help with the calculations like the NPV and the IRR discussed in previous slides. Putting all of this information together will help Ameritrade more accurately estimate their future projects and decide whether these projects will be a good endeavor. When calculating the cost of capital in this particular case, Ameritrade will have to reflect a risk premium that takes into account the uncertain future cash flows. As mentioned in previous slides, the Treasury bill provides the most accurate rate of return for the risk-free rate. The table on this slide shows different types of bonds as well as their average annual return and the standard deviation. The return in 1997 was 5.2%, and this is the rate we will use for our risk-free rate in this scenario. It is also very important to understand the expected return of the market. The S&P 500 provides a list of the 500 largest companies based on market capitalization. We can use the average annual returns over the past decade to get an accurate estimate of the expected return of the market. For our purposes, the average annual return between 1987 and 1996 was 15.97%, and we'll use this number in our calculations going forward. The table on the left-hand side of the slide can be used to see the average annual return for each year in the 10 years prior to 1997. Before moving into the discussion of market risk premium, it's important to understand the difference between two types of risk: diversifiable risk and market risk. Diversifiable risk is risk that is specific to the firm and in a market portfolio can be diversified away by holding assets that will reduce the overall portfolio risk. Market risk is not diversifiable because it affects all securities simultaneously. The risk premium of a security is determined by its systematic risk and does not depend on its diversifiable risk. Bringing us to the market risk premium, it is the return in excess of the risk-free rate. As reflected with the equation on this slide, the risk premium is the expected return of the market minus the risk-free rate. This figure is very useful in the calculation for the cost of capital. As we can see here, for Ameritrade, the risk premium would be 15.97% minus 5.2%, giving us 10.77%. Asset beta is something we touched on briefly earlier in the presentation. The beta of a security is the expected percent change in its return given a 1% change in the return of the market portfolio. In short, the beta of an asset is useful to determine the amount its value will fluctuate with a change in the market. The asset or unlevered beta is the risk of a company without considering debt and only taking into account its assets. The steps to compute the asset beta for Ameritrade are as follows: determining the beta for several comparable companies, unlever each company beta, take the median of the set of unlevered betas, and then lever the result based on Ameritrade's capital structure. Although Ameritrade is a relatively young firm compared to others on the market, we can calculate their asset beta out of 4 comparable firms by using the equation shown at the bottom of this slide. That equation is the asset beta being equal to B, the company's levered beta, over 1 plus 1 minus T, the corporate tax rate, times R, which is the debt to equity ratio. On the figure that appears on this slide, we can see all of those numbers for 4 comparable companies: Charles Schwab, E-Trade, Quick & Riley, and Waterhouse, as well as the calculated asset betas for each. This slide shows a graph that has some more information about other comparable firms. As we can see, some firms don't have the necessary information available for us to accurately calculate an asset beta. On the right-hand side of the chart, we can also see percentages of brokerage revenues for each firm. This slide provides more information on why Charles Schwab and Quicken Riley were used as the baseline, since E-Trade and Waterhouse did not have as much information available. Another factor in this decision was that Charles Schwab and Quicken Riley also had similar brokerage revenue percentages as Ameritrade. By using Charles Schwab and Quicken Riley as baseline firms for comparison, Ameritrade will have a beta between 0.114 and 1.025. The choice of Charles Schwab represents the lowest beta among comparable firms and therefore the least volatile. Quicken Riley, on the other hand, has a beta that correlates very closely with the market. An asset beta below 1.0 means that the firm has below market risk. Based on the selection of comparable firms, Ameritrade can interpret this range of beta to be less volatile than the market overall, and therefore an investment in Ameritrade is likely to be less risky than the market as a whole. Based on all this information, the CEO, Joe Ricketts, can deduce that Ameritrade has below or near market risk from an investment standpoint. This slide provides a summary of our cost of capital calculation as well as all the figures we've calculated along the way earlier in this presentation. To summarize, the risk-free rate is 5.2%, the conservative estimate of the beta is 0.114, the worst case estimate is 1.025, the expected market return is 15.97%, and the risk premium is 10.77%. Using all of these figures, we can see that the cost of capital for Ameritrade is going to be somewhere between 6.43% and 16.24%. This potential cost of capital ranging from 6 to 16% provides CEO Joe Ricketts with additional data to compare against the estimated returns on the project. If Ameritrade was to invest in additional advertising and technology, they must ensure that the return is greater than this cost of capital. Joe Ricketts himself believed the expected return on the investment would be in the range of 30 to 50%. If this is true, then it would be an easy decision to take on the additional investments. However, other members of the management team had more conservative estimates in the range of 10 to 15%. Using the lower return numbers when compared with the estimates of cost of capital here, we would not recommend taking on the investments. In order to come up with a final decision, Ameritrade must finalize their expected return for the projects and then compare that number to the estimated cost of capital presented here. Thank you for watching our presentation on Ameritrade and their cost of capital, and you can find the references used for the material in this presentation on the slide shown.